several digitally advantaged stocks benefited by the global pandemic drove the Russell Midcap Growth Index to outperform the Value Index. This strong fundamental performance of growth stocks was helped by a lower interest rate environment. The Value Index was constrained as well by disadvantaged companies from the economic shutdown. The same low interest rate environment that helped growth stocks hurt financial institutions, which is a large component of the Value Index. There was also continued weakness in the energy industry. While stock market multiples are high by absolute standards, there's good value to be captured relative to historically low fixed income yields. In the mid-cap growth strategy, we typically target innovative and disruptive companies that are taking share with large addressable markets. Companies that have the opportunity to invest in high return projects and compound those returns for years to come. Some of the new positions in the strategy this quarter include RealPage, which is software solutions to help real estate companies manage their properties, collect rent, and improve efficiencies in leasing. We also took a position in Charles River Laboratories, which is the leading provider of outsourced preclinical services for the biopharma R&D industry. They're benefiting from a robust biotech funding environment and increased outsourcing of preclinical work by drug companies. Another new stock is WillScot, which has over 40% market share in the temporary office space. We think that with their value-added offerings, internal price improvement initiatives, and market share opportunities for cross-selling storage solutions, they could be a double-digit grower despite uncertainty in the non-res construction markets. The third quarter was very strong for the mid-cap growth strategy, both from an absolute basis where the fund was up over 12%, and from a relative perspective, outperforming the benchmark by 280 basis points. Strong economic data fueled by government stimulus, accommodative fiscal policy, and improvement in the labor market drove absolute returns. The ISM recovered to expansionary territory entering the quarter, and the ClearBridge recovery dashboard shifted to green in the June 30th update. The sectors that drove relative outperformance were consumer discretionary and communication services, with much of that success driven by favorable digital trends in e-commerce as consumers shift their purchases online at an increasing rate. Carvana is one of the stocks in the portfolio that is a leader in online used car sales. It saw significant success this quarter, driven by the pandemic accelerating the penetration of online used car sales. So Carvana is a great example of an innovative company that's disrupting a mature market and taking share. Pinterest is another company that led outperformance for the strategy. It's a social networking site that is early in its timeline to monetize its user base, which is both a high value demographic and one that has purchasing intent. Pinterest is also in the early stages of integrating click-to-buy shopping features to the platform, which can help further accelerate monetization of their users. Also driving outperformance was Varian Medical Systems, a leader in radiation oncology equipment, which was acquired by Siemens during the quarter, as well as PPD, a contract research organization, which continued stellar execution while its centers reopened and clinical trials resumed. Real estate was a modest detractor, which was driven by weakness from Jones Lang LaSalle, a provider of commercial real estate brokerage and other services. We exited the position in the quarter due to increased uncertainty in the commercial real estate markets due to the global pandemic. The economic visibility in the US over the next 12 months is murky. We don't have foresight into the timeline of an approval and distribution of a COVID vaccine. We don't know what the election outcome is going to be, and we don't know whether there's going to be another fiscal stimulus implemented. We're monitoring these issues, but we don't believe our strength as a team is best suited to make projections on them. We do believe, however, that our individually vetted and de-risked growth investments form a portfolio that can perform well in many types of economic environments.